Do you wish that all things wealth and finance were much easier to understand and not presented by a bunch of beige cardigan-wearing geeks? Welcome to the Clever Investor Podcast, where we're dishing up the easiest to understand finance program served in bite-sized chunks, so your brain will thank you as your knowledge grows. Hosted by the brilliant Owen Taylor, a multiple award-winning expert with a glorious knack for explaining the complex world of wealth in the simplest of ways.
Hello, clever investors, and welcome back to another show. Today, we're going to talk about lender's mortgage insurance, very commonly abbreviated to the letters LMI. What is it? And why you should not be scared of it. Now, there's certain things in life that are meant to terrify us, things that go bump in the dark, clowns hiding in stormwater drains. But lender's mortgage insurance is a lovely, big, cuddly monster that we all really need to learn to embrace. I want you to dispel the myths that you've been told at those barbecues that I always talk about. So many people misunderstand exactly what lender's mortgage insurance is. So let's go back. Let's do a bit of history of lender's mortgage insurance. So LMI was introduced into Australia in 1965 with a really simple purpose of helping first-time buyers get into the property market earlier. Because you can see way back then, it was just as hard for people to save up a 20% deposit as it is now. Lender's mortgage insurance, as the name suggests, is an insurance policy. But unlike your car insurance, the insurance policy is covering the bank, the lender, the credit union, the building society, and it's covering them for any loss should the property that you've bought go sour. You get foreclosed on, there's a forced sale on the property, and it sells for less than what the bank is actually owed. Now, it could sell for the same amount. You owe 200,000, it sells for 200. When a property goes into foreclosure, so when a lender has to force a sale on a property because somebody's stopped paying the mortgage for whatever reason, you can understand there's a lot of legal fees involved, and it probably takes roughly somewhere between maybe 6 to 9 months before they can actually kick somebody out of the property. So the lender has incurred some legal costs because it has to go to the courts, and the court has to actually say whether or not they can. Under the law, basically, the lender is not allowed to profit from the foreclosure of a property, and if they're short of any funds, then they can claim it on this lender's mortgage insurance. Policy is valid for the life of the loan. LMI protects the lender in the event that the borrower defaults on the residential mortgage. If the security property is required to be sold as a result of that default, then and the sale proceeds don't cover, then they can claim the difference on this policy. Now, I've mentioned in previous shows that the lenders of residential mortgages, which I generally called banks, but it's, as we know, it's not just banks that lend against property. It's easier to say bank though. Lenders don't really care too much about property. What they care about is risk. And what they want to do is when they're lending us money for whichever purpose, but in this case here we're talking about residential property, they want that risk to be as low as possible. That's why you have to fill out an application. That's why you have to give them pay slips and show them what your savings patterns and what your spending patterns have been and how many credit cards you got. All of that is to prove that not only can you afford to borrow this money, but you're also going to be a good person to be able to pay it back. So they're mitigating their risk. Now, it's the same thing with how much money they're going to lend us in proportion to what the value of the property is. Have you ever thought, why is it that the banks won't lend you 100% of the value of the property? Well, because the risk is so high. if there was any default, if they had to sell the property, then chances are they're not going to get the money back that they're owed. And as we know, banks love making profit and they don't like losing money. So this is where lender's mortgage insurance comes in. The bank says, ideally, they want a 20% buffer in any mortgage deal that they do. That's the minimum. Have you noticed when you look at mortgage rates, the lower the loan to value ratio, which is a risk ratio, the cheaper the money you can get. So to mitigate this, what was basically invented in the mid-60s was this insurance policy that would cover the lender in the event that there was a default. Many people at barbecues get all upset in the fact that they go, well, after a couple of years you got equity in the property and you paid it down, but you don't get any refund on the mortgage insurance, yada, 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 yada. Remember what I said. It was invented with the simple purpose of helping first-time buyers, and it's not just home buyers, it's investment buyers as well, helping them get into the property market sooner. And LMI is now an integral part of the funding of so many properties in Australia. And I've even had clients that have had enough money to pay a 20% deposit, but we've chosen to go ahead with a deal which has got some mortgage insurance in it to keep that cash off to one side. So they may be buying a property, especially first home buyers, which is going to need a bit of work. Maybe it needs new carpet or a new kitchen. If they put all the cash in towards buying the property, well, then they've got nothing to spend on renovating, or they actually haven't had what I consider the most important thing is a buffer. Imagine if the car engine blows up, they need 4 new tyres, they've got to fly somewhere in an emergency. You need cash. Cash is always king in that situation. So don't be scared when you're sitting down and your mortgage broker suggests that maybe you put a little bit less in, pay a little bit of mortgage insurance, which can often be capitalised into the loan. Now, what that means is that in certain circumstances, the lenders will allow you to add the premium onto your borrowed amount. Yes, your monthly repayment goes up, but you've then got to flip it over and look at, well, I've now got a buffer of money off to one side. Now, when we're looking at these things from an investment point of view, capitalising the mortgage insurance can actually be a positive thing because you've borrowed that money. It's part of the borrowed funds. So therefore, you can potentially have a better offset from a taxation point of view. Now, the LMI industry of insurers, there's basically a couple of independent or privately owned LMI companies in Australia. And then there's a lot of the lenders who have actually got a stake within their mortgage insurance companies. A couple of them are even what we call self-insuring. Now, the mortgage insurance premium is based on 2 parts. How much you're actually borrowing, what's the base mortgage amount that you're going to be borrowing, and then the risk ratio, so that loan to value ratio, which is basically worked out by the loan size that you've got and how much the value of the property is you're buying or you're refinancing. The more you're going to borrow, the higher the risk ratio, the higher the lender's mortgage insurance premium will be. As a general rule of thumb, you're not going to pay lender's mortgage insurance when the loan to value ratio is below 80%. There's also some circumstances where certain professions don't have to pay lender's mortgage insurance on some loan products. Atypically, it could be people that are in the medical profession. They talk to your mortgage broker as to whether you qualify for that. It's not available for all lenders and it is at their discretion, and you often have to be a member of a professional organisation. So if you're a doctor, you've got to be an AMA registered doctor. Lender's mortgage insurance is not a big ugly monster. It's a fantastic tool which enables so many people to get into the property market so much sooner than what they could. It's said now that the median time for Sydney-siders to save up 20% of the median house price is nearly 14 years. 14 years to save up 20% of the Sydney median house price. Now, the only way to avoid paying lender's mortgage insurance is to either have a 20% or greater amount of money that you're putting towards the purchase, commonly referred to as the deposit. The only other way to avoid it then is to offer the lender security of another property. And that means that the overall loan to value ratio will be below 80%. So this might be another property that you own, or it could be that there's a very nice friend or close family member which is going to allow you to use one of their properties as security guarantee. Again, this is something, talk to your mortgage broker about this. This is type of loan facility is known in the industry as a family guarantee, but it doesn't always have to be family. It can be a very close friend or something. Different lenders have different policies on it. Talk to your mortgage broker about it. If you can't do that and you've got to pay mortgage insurance, don't be upset about it. I could not have bought my first property way back in 1995 without lender's mortgage insurance. I borrowed the full 95% of the value of the property, and we were able to actually capitalise or add the lender's mortgage insurance premium onto the loan. So effectively, we borrowed about 97% of the value of the property. Don't let it put you off. Don't be scared of it. It's a fantastic tool. I'll see you again next week for another edition of the Clever Investor podcast.
You have been listening to the Clever Investor Podcast, proudly sponsored this week by Blue Wealth Property. Are you ready to start a new investment journey? Get in touch with the industry leaders, Blue Wealth Property. Blue Wealth have a proven track record in using research to identify growth markets, and Blue Wealth have supported thousands of Australians to buy the right property in the right market at the right time. Go to bluewealth.com.au.